WatchGuard Capital. Invest your time wisely. Hi there, I'm Steven with WatchGuard Capital, and this is a quick breakdown of the video you're about to watch. The views expressed in this video are my own. Congress established the Military Retirement Fund in 1984 to absorb military retirement costs, which freed up the military to buy more ships, planes, and missiles with its annual budget. One small problem with the fund is that it's structured like an intergenerational Ponzi scheme to liquidate unfunded liabilities by double counting tax revenue, which basically means we made it up. In October of 2019, I submitted an idea to the military to invest 25% of the military retirement fund in something that wasn't made up, specifically 3 stock market investments, with real underlying assets and income streams, which it declined. 23 months later, I was wondering what would have been the net effect had they implemented my idea. Turns out it would have saved over $700 billion, or $31 billion per month. So in the near future, when we keep hitting the debt ceiling faster and faster, our interest expense bill blows up, Congress starts talking about raising Medicare and Social Security taxes, inflation takes off, and the number of people serving in the military is cut, know that that is all interconnected and has more to do with the structure of the government's budget system and our trust funds and less to do with the individuals who are currently in office at that time. But those individuals are most likely ignorant on both finance and monetary theory and under-equipped to address our national debt issue. Now, those are pretty lofty claims, so without further ado, this is Optimize the Military Retirement Fund. This is the most recent report for the Military Retirement Fund. In this video, I show how improving the returns of this fund would improve our national security, much like improving the investment returns of your own retirement funds would improve your personal security. The Military Retirement Fund provides benefits for military members' retirement from active duty, the reserves, disability retirement benefits, and survivor benefits. It was established October 1st, 1984. Needless to say, it's a very important fund. This is the National Defense Budget estimates for 1984. You can find military expenditures as far back as 1946 in it. In 1946, the military spent a total of $36.5 billion. 46.5%, or $17 billion, was spent on current military personnel, and 0.2%, or $85 million, was spent on retired personnel, which as a percentage of total spending was an extremely small amount. By 1984, only 38 years later, 2 years shy of one 40-year career, the military was spending $16,806,000,000 on retirement pay, 19,671% more than 1946, which is one of the reasons why Public Law 9894 was passed. Because when it was, it established the Military Retirement Fund. It directed all future military retirement benefit payments to be made from the Retirement Military Fund and not from annual military budgets. It called for a board of actuaries to advise the President and Congress on the soundness of the Military Retirement Fund to meet military retirement costs. And it limited the investment of money placed in the fund to investments that would expand U.S. national debt, which will have to be paid back with future taxes or some other form of future national debt. This is the website where you can find the Board of Actuaries reports. And this is the most recent one available at the time of the release of this video. One of the first actions of the board was to estimate the unfunded liability, or the value of military benefits that had been earned prior to the creation of the Military Retirement Fund, which they estimated at $528.7 billion in 1984, or approximately $1.3 trillion in today's dollars. Once that number was known, they calculated how much had to be contributed each year to cover unfunded liabilities and also future earned benefits as well. This table shows that information from 1985 to 2019. This chart can be found on page 15 of the 2020 Military Retirement Fund report. It will help illustrate and track the flow of funds from 1985, the first year the Military Retirement Fund was in existence. The military paid service members $33.5 billion in basic pay in fiscal year 1985. And the Board of Actuaries determined that the Department of Defense needed to contribute $17 billion from its annual budget towards retirement costs that were earned that year. So the Treasury transferred $17 billion to the Department of Defense, who then transferred it to the Military Retirement Fund, which is located at the Treasury. The Treasury contributed another $9.5 billion from the General Fund to the Military Retirement Fund to cover a portion of the unfunded benefits that were earned prior to the establishment of the fund. The Treasury also paid the Military Retirement Fund $1.1 billion in interest on the money it deposited throughout the year, which brought the fund balance up to $27.6 billion in resources to pay retirement benefits. The fund disbursed $15.8 billion in retirement benefits to service members and surviving spouses that year, which left the fund with a year-end balance of $11.8 billion. And at this point, If you're wondering, how did the military retirement fund that started with a $0 balance at the beginning of the year, that received contributions from the Treasury Department throughout the year, end up being owed interest by that same Treasury Department on loans that it made back to itself? I wondered the same thing and made this video called Myself IOUs, where I explain how that happened, which turns out to be both extremely interesting and extremely terrifying, and I would encourage you to watch it. But for now, a $17 billion contribution by the Department of Defense was turned into $15.8 billion in benefits and $11.8 billion in national debt thanks to the structure of the military retirement fund during fiscal year 1985. Now let's look at what happened in 2019, the most recent year available. The military paid service members $69.1 billion in basic pay. The Board of Actuaries determined that the Department of Defense needed to contribute $20.5 billion towards retirement costs that were earned that year from the annual 2019 military budget, only $3.5 billion more than the fiscal year 1985 contribution. The Treasury Department contributed $7.9 billion in normal costs to cover a slight increase in future cost expectations, $88 billion to cover a portion of the unfunded retirement benefits earned prior to the establishment of the fund, which was a $78.5 billion increase from the $9.5 billion that was contributed in 1985. It also contributed $27.4 billion in interest on assets of the fund, $26.3 billion more than 1985. So the fund had total resources of $143.8 billion in 2019 to pay retirement benefits. The fund dispersed $60.7 billion in benefits in 2019, $44.9 billion more than in 1985, which left $83.1 billion in unused resources that year, and increased the fund's year-end balance from $813.9 billion to $897 billion on paper. And since the underlying investments are 100% comprised of national debt, increased our national debt by $83.1 billion. Which brings me to my first idea on how to solve national debt that I submitted to the military in October of 2019. What if instead of buying investments that increase our national debt, we bought some real assets that didn't? Adding these 38 words in red to National Law 9894 would allow the fund to invest up to 25% of its resources to purchase stock market indexes in the U.S. economy. At the time, I estimated it would save $9 billion a year indefinitely with zero cost to implement. But now that I know how poor our financial collective position is, how deficits don't actually capture the true cost of our decisions, how unsustainable this fiscal path is, and how the structure of our budget system works, not only would I still recommend 25% of the annual surpluses in the military retirement fund be invested in stock market indexes that don't drive national debt higher, I would have recommended we take 25% of the fund's $896.8 billion balance in October 2019 when I submitted this idea and move that into stock market indexes as well, and this is how that would work. This was the fund's investment structure in September of 2019, and as a reminder, it's 100% national debt. Imagine selling or redeeming 25% of each of these investment types for cash. 75% or $672.6 billion is untouched and proportionally stays invested exactly the same way in those investment types. The 25% or $224.2 billion that was liquidated or redeemed for cash is then invested in 3 stock indexes: large U.S. companies, small U.S. companies, and an aerospace defense fund, so that if Department of Defense vendors go over cost budgets, which routinely happens and positively impacts their stock prices, the Department of Defense's retirement costs would decrease to hedge against vendor gouging. 23 months have now passed since I submitted my idea to the military, and I wanted to see what the net effect would have been if they would have implemented my recommendation. The first thing to calculate are the cash flow structural savings. Resources necessary to pay retirement outlays would not have changed, which were projected to be $62 billion in 2020 and $64 billion in 2021. This video was created in September, the 12th month of the government's fiscal year, so I'm going to multiply each number by 11/12 going forward to capture partial year data. In this case, the government distributed approximately $58.6 billion as of August 31st, 2021. Thus, $120.6 billion was needed to pay military retirement benefits. As these are costs associated with the Department of Defense, its contributions will remain the same: $21.9 billion in 2020 and $25.3 billion in 2021. So in total, they will cover approximately $45 billion of the $120 billion in cost, which leaves a $75.5 billion shortfall. The Treasury Department was slated to contribute $91.9 billion in 2020 and $98.1 billion in 2021 for benefits earned before the fund was established, for a total of $181.8 billion. But if my recommendation was implemented, this amount can be reduced to $75.5 billion to cover the remaining shortfall that was actually paid to retirees, and internal savings of $106 billion. Additionally, the Treasury Department was going to contribute $8.5 billion in 2020 and $9.8 billion in 2021 for adjustments in expected cost, which could be eliminated and saves another $17.4 billion. Thus, the structural savings would have been $123.7 billion under the recommended plan if implemented. So far, the total net change and savings is $123.7 billion reduction in required Treasury Department contributions to the Military Retirement Fund. The next thing to calculate are the investment savings. To do so, we need to know how the current investment strategy did without implementing my recommendation first. As a reminder, I recommended this idea in October of 2019, so that is when our analysis starts. According to the fiscal year 2019 Military Retirement Fund report, the fund had a balance of $896.8 billion. And according to the 2019 valuation of the Military Retirement System report, the fund was expected to earn 4.75% annually, or about 0.4% monthly. If the $896.8 billion fund did achieve that rate of return, it would have generated $3.5 billion in interest in October of 2019 and brought the fund balance up to $900.3 billion. If it achieved that rate of return for 23 months through August of 2021, it would have generated total interest of $85.3 billion and brought the fund balance up to $982.1 billion. And thus, my idea or recommended investment strategy should be compared to and improve on these numbers. So let's do those calculations now. 75% or $672.6 billion is left unchanged in the military's current strategy and proportionally invested the exact same way. However, since the amount invested in the strategy was reduced by 25% down to $672.6 billion, it would have earned $2.6 billion in interest, which was $887 million less for the month of October 2019. And if the fund earned the same 0.4% for 23 months, it would have earned total interest of just shy of $64 billion. Now this is where things get really interesting, because there's been an obvious change in the amount of interest earned, but the impact may not be obvious. Under the current strategy, the Treasury Department pays the Military Retirement Fund $85.3 billion in interest, so that is an interest expense to the Treasury Department and interest income to the fund. Under the recommended strategy, the Treasury Department pays the Military Retirement Fund $63.9 billion in interest, which is a $21.3 billion interest expense reduction or savings to the Treasury Department, but also a $21.3 billion interest income reduction or loss to the Department of Defense. But since the interest that is not used to pay retirement benefits is invested in Myself IOUs, which increases national debt, we'll count it as an interest savings. The lower initial deposit of $672.6 billion and the lower levels of earned interest over the 23-month period results in a lower ending final balance of $736.5 billion, which is really interesting again. Under the current strategy, the Department of Defense has $982.1 billion in the fund in Treasury Bonds or Myself IOUs to pay future retirement benefits, and the Treasury Department and future Americans have an obligation to pay back $982.1 billion with future taxes or redeem it with other types of national debt. Under the recommended strategy, the Department of Defense only has $736.5 billion in Treasury Bonds or Myself IOUs to pay future retirement benefits, and the Treasury Department and future American citizens only have an obligation to pay back $736.5 billion in national debt, so there would be a $245.5 billion reduction in national debt. Another way to look at that is that as long as the value of the recommended stock index fund is larger than the reduction of these Myself IOU Treasury Bonds, the Military Retirement Fund would be in a superior position to pay future benefits because it is more diversified, must have achieved a higher rate of return on plan assets, and would now have an external asset that does not require future tax collections or treasury operations to convert this type of debt into a resource that can pay benefits. So let's calculate the rate of return on those recommended stock market indexes now. 25% or $224.2 billion was recommended to be placed in 3 stock indexes. 15% or $134.5 billion in the large US stock index, 5% or $44.8 billion in the small US stock index, and the same 5% or $44.8 billion in an aerospace and defense stock index to hedge against defense contracts going over budget. Now these are the actual returns these stock indexes achieved from October 2019 to August 2021. And these would have been the ending values of these investments if my recommendation had been implemented. The The large U.S. company investment grew from $134 billion to $210 billion. The small U.S. company investment grew from $44 billion to $74 billion. And the aerospace and defense investment ended up about the same at $44 billion because of the damage COVID-19 did to the aerospace industry. Collectively, this is the performance and balance of the three stock market index investments. The final balance as of August 31st, $329.1 billion. The current plan is invested 100% in Treasury Myself IOU bonds, so there's no stock indexes or external investments available to sell in the future. The recommended plan would have had $329.1 billion in stock index assets to sell, improving the fund's position by $329.1 billion. So the total change, or savings, would have been $123 billion in structural savings because the Treasury doesn't have to keep up the farce of liquidating an unfunded liability, $21 billion in interest savings because the military retirement fund decreased its position in Treasury bonds, a reduction of $245 billion in national debt, and an increase in non-U.S. national debt stock market index assets of $329.1 billion, for a total change or savings of $719,745,569,111, or an average savings of $31.2 billion per month for 23 months. To put this in perspective, according to Statista.com, that monthly savings is more than all but 10 countries spend in a year on national defense. And if you save $31.2 billion a month for 12 months, that would be $374.4 billion in total savings for 1 year, enough to fund about half of the United States annual Department of Defense budget. And when I made the recommendation we move 25% from Treasury Myself IOU bonds into stock market index assets in October of 2019, it wasn't because this was the optimum portfolio. It was because this is a Ponzi scheme-like structure, and I was concerned about putting too much pressure on it. But a few months later, the government passed a multi-trillion-dollar stimulus package, so I guess my concern was unfounded. So I went back, and instead of leaving 75% in the current strategy, I reduced that number down to 50% or half, and I put the other half in stock market indexes. The structural savings are exactly the same, $123 billion. The current strategy is not impacted, $85 billion in interest collected, final fund balance of $982 billion of national debt. The 50% invested in the current strategy earns the same 4.75% annually or 0.4% monthly, but the reduction in initial investment reduces the total collected interest to $42 billion and saves the Treasury Department $42 billion in interest payments. The final Treasury Myself IOU balance is $491 billion, and since this is national debt that presumably has to be paid back in the future, save the Treasury and future American citizens $491 billion. The 50% invested in the recommended stock investments earns the actual returns of those stock market indexes from October 2019 through August 2021. The final balance of those assets is $658 billion. And thus, the military retirement fund's position would have been improved by that amount. The total change or savings from implementing a 50% shift to real assets would have been $1.3 trillion or $57.2 billion per month if averaged out over the 23-month timeframe. We need to acknowledge that the trust funds we created to ensure our future safety and prosperity in the past were done so under a completely different set of monetary conditions and were stopgaps until a better idea was presented, which I now have. We don't have to default on our previous promises, but we can't double down on the systems that are now generating certain unsustainability. We need to optimize and diversify the military retirement fund in something besides Treasury Myself IOU bonds for the security of our future. I'm Stephen with WatchGuard Capital, and until next time, invest your time wisely.